Hey everyone, my name's Andy. My channel's Finding Value. If you like making money, subscribe to the channel. Love to have you on the community and on the channel to ride this bull market up in commodities with us. I did listen to a David Hunter interview. Someone wanted me to listen to it and make some comments. That's what I'm doing. And I made a presentation on interest rates because that's what he's talking about a lot. And it's important to understand interest rates and how they affect our investments. So let's dive in here and look at interest rates. So we're going to cover Treasury bond yields and PE ratios and how those two are inversely related. I can explain all that. So first I want to cover the long-term interest rates and what impacts those and give you my opinion. This is my opinion on what affects it. You can see cycles here, cycle up, cycle down, cycle up, cycle down. You can see these cycles. And the up cycles, in my opinion, are demographic driven. They are driven with real estate going higher, which creates inflation, which is from demographics. That's what these secular interest rate cycles are. On the downside here, we had lots of wars, World War II, the Great Depression, World War I. American Civil War, Mexican War, and we had this big decline in interest rates. Outside of this short cycle here between 1900 and 1914. Here was a big baby boomer generation buying homes all through here. So that's what I think drives inflation. That's what drives interest rates, is demographics. So let's see how interest rates look like today on a short-term basis. And that's what it looks like. It's been declining since 1980. Decline, 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 decline. Now, let's see how this inflation interest rates impacts the S&P 500 ratio. So this one's the S&P 500 PE ratio versus inflation. It should really read interest rates. So when inflation goes up, interest rates go up. And what happens is the price to earnings ratio gets discounted. Future cash flows get discounted to today for a net present value using a higher interest rate. So what that does is that if you have a higher interest rate, you're going to have a lower PE ratio. It's going to go down and down and down because people aren't going to pay up for future growth if you have other options on the table, like a risk-free treasury bond yield that will pay you a higher percent. But in general terms, when you have higher rates of inflation with higher interest rates, the PE multiple usually declines. Now, when it contracts down, usually it goes in reverse. The PE ratio goes to greater multiples. So we're going across. We've had very low rates here, 6% U.S. Treasury bond yield. And the way that you try to prop this up and keep it higher is you're going to have to go lower and lower on your bond yields if your earnings are not that good. So in order to prop this all up, they're pushing interest rates down. Down, down, down to keep that PE ratio multiple high. Here's the S&P 500 PE ratio versus a 10-year Treasury yield. Here's the current. We're right here. And you can see how this line goes down as your Treasury yield goes up, which means as your yield, 10-year Treasury yield goes up, your PE ratio declines. It goes lower and lower and lower. So if you want to buy stocks on a secular basis, you would want to buy them over here when interest rates are high and interest rates are in a lowering phase. That's where you want to be. But right now, we are way over here, which is interest rates are low. And if interest rates go up, this is going to go down, which means prices are going to go down. And when David Hunter says that he thinks that the price of the S&P 500 is going to decline 80% or some large number, he is talking about interest rates going up and PE ratios contracting. Moving down this curve here is what he's talking about. Here's another chart just to show you US bond yields versus S&P 500 ratio. It's the same thing. It shows it declining. I just wanted to show you a different statistic from 1960 to present. So looking at this stuff, interest rates are very important. And you've heard me talk about this on the channel before. I said that I think interest rates are going to go up because of demographics and because of real estate. Those two things. Those two things are going to drive inflation. Inflation going up is going to create a real negative interest rate, which means that people who hold bonds are going to be losing money. And when they see that, they're going to sell their bonds. And when people sell bonds, it puts pressure on interest rates to go higher. As long as inflation is increasing, more and more people are going to sell bonds, increasing the interest rates. That's that dynamic. As interest rates go up, it's going to put pressure on stocks to be discounted using different interest rates. And that discounting of a higher interest rate is going to contract the PE ratio down, causing stocks to fall and causing money to rotate out of stocks. So money is going to rotate out of stocks, it's going to rotate out of bonds, and it's going to go into inflation protected securities like TIPS, like commodities, and like precious metals, because those are where you want to be. Real estate is also another area to be in, as we are in an expansion phase of real estate, which means higher real estate prices. And it's going to be demographic driven, and we need a lot more new homes to be built. If those homes aren't built, if we run into high costs of lumber, which we are, and people are unwilling to pay the high costs, what it's going to do is drive all the existing homes higher. And you're going to have less homes with more buyers competing after less and less homes. And eventually, what most people will probably do is give in and pay the higher prices to buy a new house. That's my guess. Otherwise, you're just going to have a bunch of people fighting for fewer homes. That's what it's going to be. Now, the moratoria, there was some questions about the moratoria ending and the impact on the real estate market from that. I don't think it's going to impact it for a very long time. I think it's going to be it's an event-driven problem in a secular bull market in real estate. The demographics for the bull market, I would say, are going to end around 2028, 2030. That's my guess. And I think this event, the moratoria ending, may impact it for 6 months to a year, maybe. So it could slow down the rate of growth. Maybe it puts even a little dip. Maybe it goes flat. I don't know exactly the ramifications of it in terms of a short-term problem, but it'll probably slow it down. It'll go through it like it's a speed bump, and then it'll go back on right to where the structural thing is. It'd be just like COVID had. That impact of COVID, it'd be the same impact on the real estate market as the impact was on the S&P 500. But I don't think it's as large because there isn't as many homes as recent problems. So I don't think you're going to see a 20 or 30% decline. I think you might see a flattening of things going up. So it may go sideways for a year or something like that. It may it's not going to go up 20, 30, 20% like it is right now, 10 to 20%. So it'll just flatten out. So that's my take on the moratoria. And again, I don't know exactly how many homes are going to come on. I don't know exactly when. I don't know if they're all going to get dumped at once. I don't know that information. I have no idea how they're going to handle it. I don't think anyone does. And remember, they're the banks. So the banks control this. They have loans against those homes. They're probably going to do something that's going to be in their favor. That's my guess. So now you know what the correlation is of interest rates and how they impact net present value calculations. That gets discounted. The higher the rate, the more compression of the PE we're going to see. So stocks will sell off or go sideways for a while. If you guys like this content, give me a thumbs up. Leave any comments below in the comments section. Love to hear your opinions. And thank you for listening. This is Finding Value.